Ajay Srivastava joins us. Ajay, good morning. The match got over by 10 o'clock. You were running late. Was it a late night even though India lost?
Yes. I think it was a late night because we had to drown our sorrows. With all the expectations and all the celebrations ready, the champagne had to go back to the cooler, and we had gone back to the old thing to say, "My God, once again." It was deja vu for me because I was there for the South African finals, watching the match there when we got hammered. So I think I've decided I will not watch any more finals again. Maybe I am the jinx person.
I love the Times of India headline today that one head broke 1.2 billion hearts. I love that
I
line.
know. It's second time over for us, so I think maybe in this life we'll never see a World Cup up in our hands, but I hope so.
It's are doing very well, so you should be happy.
All the best to the guys. I think it was sad. I think it was sad because we didn't fight. And that's the point I say, you lose, but you fight. You don't hit a four in 20, 30 overs in a one-day international. It's bizarre to say the least. I don't know. I don't want to criticize, but this is not what we paid for yesterday.
But markets are doing well, Ajay. So I think there is reason to smile. I mean, we've just done much better than what everybody thought at the beginning of the year.
Well, yes, answer is yes. But if you look at the vast majority of people who have got invested in the large cap funds, who got invested in the banking fund, I think for them it's not been a good year at all at this point of time. So yes, there are a big pockets of market which have done reasonably well, or quite well, or exceedingly well in that order in the mid cap, small cap. But if you look at the vast universe of money invested in the large caps, that's been a very, very disappointing year for them. And we keep saying it's going to repeat itself next year. And that's the sad irony that a large portion of funds of retail public are not making even a decent return. So yes, the general market has done very well for most investors. Most PMS portfolios have done extremely well. Individuals may have done extremely well. But I think the general public, which are invested in large caps, I think had left disappointing. And you've seen what's happened to the banking index in any case. So I think, you need to bifurcate the market saying exceedingly well, very good, and very, very disappointing. Large caps have been part of the very disappointing bucket.
So where are you picking your spots? Are you going back to large cap and say that disappointment means value and excitement means no value? So small cap is exciting but no value. Large cap is disappointing but there is value.
Well, it's I don't know how to say this, but it's very difficult to find value in today India. India is not a value market. Everything is expensive at the end of the day. So you're really buying momentum. You're buying PE expansion at this point of time. You're really very, very few, far and far between. You will find a value stock. You may consider the PSU bucket to be the value stock because those are the only ones in single-digit PEs and decent cash flow, etc. But really speaking, across the board, there is no value in this market. This market is about momentum investing. This market is about new stories coming out. This market is about government spending themes. So, I think you'll be waste your time if you buy value in this market. Value can go on forever, not recognized. And really speaking, at P's of 25 and 30s, except for banks, I think you're really difficult to find value. So forget value. Nikunj, I would say this year, next year is going to be back to momentum investing and wait for corrections when you buy. What you buy at will dictate what you make, not what you kind of keep adding up and so on and so forth. So value concept out from Indian market. We are expensive market.
Ajay, when you're referring to that PSU pack, which is cheaper, which ones are they? Is it just the bank part you're referring to, right? Because it can't be railways or defense or even power utilities have run up quite a lot.
Yeah, even after they run up, let's take the metal stock, let's take even the power utility stock, let's take the transmission stock. I think in comparison to their NAVs, in comparison to their book values and the rest of the market, they're still significantly cheaper. Yes, they have run up, you're right, absolutely correct. But the fact remains, compared to rest of the market, this bucket is still quite cheap. Now, yes, it has not done really well in the last decade or so, but things do change. Happen. Dividend flows have become much higher from these companies, so that extent is much better for investors. And I keep saying, there's Hindi mein kahavat hai, mara hathi bhi sawa lakh ka hota hai. So how bad can they get? If they get bad, you buy more, and so. So I think as a bucket, whether it's transmission stock, power stocks, metal stocks, the material stock, commodity stocks, and of course the PSU banks, you name it across the board, the valuation is significantly cheaper than the rest of the market. Now, that would give you better return. I hope so. Higher risk, certainly so. The only one we don't want to invest in is going to be refining companies. because they're not really companies, they're government departments. So you don't know what you're going to make out of them. So I think apart from the bucket of the refining companies, rest, I think entire lot of PSU is still a pretty cheap lot compared to rest of the market.
Okay, morning Ajay. Let's get in your
Good
take
morning.
as to what you make of the entire new age tech basket. Given that now you have a lot of these companies that are focusing on profitability, have really pulled up their socks in a certain sense. Is this a sector that merits a relook? There's so many IPOs as well that are hitting the market. Tata Tech, for instance, will be closely eyed this week. Your take?
Oh, that's the beauty of this market. And I think that's where the Indian investor need to go. And, we have told our team that in the matter of, we should have more than 50 to 60% investment money in companies which are less than 3 to 4 years on the bourses. I think that's the more important one. There's so many new themes coming out in the market. These have got new age ability to harness large number of customers at a very short cost base, don't need to physically expand. So, it is given that if you're not having in a portfolio these new age companies, I think you're missing out on the big ride in the market. You want to allocate still to the cement stock or HDFC Bank, you can do at your own risk. That's really not the way you're going to invest in the next year. I would still recommend new age has also come with monopolies. If you see whether it's payment systems, food delivery companies, advertising companies, lounge companies, you name tech companies, defense companies, all of them are in semi-monopoly or monopoly status. And this can't be built over time. The cash burn is by and large over at this point of time. Most are at least EBITDA positive. So you're really coming in at a time, yes, they have run up quite a bit. To be fair, most have doubled in the last 6 months or so. So you go to pair your investments. But if you don't have more than 50% of your investment in new age companies, I think you'll do injustice to your portfolio. The old companies need to be given out of your portfolio. It's like your old wardrobe. You need to take out your old clothes out of a wardrobe, right? Don't take out your old men out of your homes, but at least the wardrobe out of your homes and substitute with the new latest ones. That's what the portfolio is all about. Button is refresh at this point of time, not to go back to pedigree stocks.
Antique paintings, antique cars, vintage wine, everything old does well, my friend.
See, you are a rich guy. That's why you talk about antique wines and antique, 40-year-old, 50-year-old scotch. I'm talking of ordinary people like us who like to just focus on wardrobes. If we can afford more than that, we are lucky.
My friend, it is just that I don't have money, that's why I don't change. And because it is I don't have money, I don't change becomes old. It's the other way around.
No, I think you're right in a manner of speaking. But as I said, some of our older companies, look at what HDFC Bank has done. The biggest destroyer of wealth for the merger in the company, for the best known company. Just see what a protection of RBI competition can do to an industry. Banking is one such. The moment the umbrella of no new licenses went away, you see the true performance has come out. And it's a disaster. The banks are a disaster in India, absolutely. The quality of service, pathetic, absolutely. And, it's sad to see what's happening in the Indian banking industry when on one side automation is building up, but the customer service is collapsing at the end of the day. You must have read about the attrition levels. So, these are big behemoths. They ran their run because of the protection of RBI. You don't get RBI protection. These banks have come out to be true what they are. They are poorly performing companies at the end of the day with poor managers who got themselves rich by ESOPs at the end of the day. That's what these companies are. So I would say, go for the new guys. You got greater hope, greater excitement, and greater thrill of working on new sectors. As you rightly said, look at the number of IPOs in this country. Fantastic, absolutely. Look at the choices we got. Superb. So why would you go back to the old order? Do not, I recommend.
Let's look at something which you will say, okay, I want to buy this stock and I'm just waiting for a better entry point. It could be 5%, it could be 15%, it could be 20%. That's a judgment call. But which are the names where you think that the business is durable enough to give you a 20 to 25% growth? That is, you're just waiting for that right price, maybe that moment of panic or that moment of turbulence in the market, and you're happy to press the buy button.
See, very clearly, the MNC infrastructure stocks, the 3 or 4 of them qualify in that category straight away. You want to be there in the company because you haven't underinvested. Number 2 is certainly the companies like the payment system companies, certainly the food delivery companies. I think the runway for these companies, infrastructure for relating to railways, infrastructure relating to power systems, infrastructure relating to the general, build-up of the economic assets, including transmission assets. Those are the sectors where the growth runway is incredible. And that's one. Number two is, if you look at the monopoly of the payment system company, one company. If you look at duopoly of food delivery, two companies, and they will not become food delivery anymore. They'll become advertising companies like US has become. Phenomenal entry. I think that's the new delivery, the retail companies which are coming out. I think those are fantastic companies, which if you get a price reduction, you go buy those companies. So I think these gamut of companies is one way would do it. PSU defense, yes, if they correct significantly, we would add on to it. We already hold the stocking, but yes, we would like to do it, but they're really very expensive. But at any point of time, I still believe that the PSU companies in defense represent the best and the worst opportunity. Why I say best? The runway is unlimited. Why I say worst? One government decision which says that you will not get 14.5% margin or 12.5% margin and 6 from here and onwards from the order from defense industry, the whole fortune of the company changes. So please understand, defense companies represent the best opportunity because the runway is unlimited and there's monopoly. The worst, because one government diktat on what they make on every order can change the fortune of the company. High risk, high reward. I think it's poker at best.
QSR, there was a lot of interest in the market, and understandably so, because the numbers were supportive. But last 1 or 2 quarters, we are witnessing the darlings in the QSR space, Westlife, Jubilant, all of them getting a knock on their QSR, the rate of growth. And hence, some of them started looking slightly expensive. Do you like that business at current levels? Or some of them?
We have no investment. No investment thesis. The competition from Cloud Kitchen is enormous. Nobody wants to go out and eat at a McDonald's. Maybe a kid once wants to eat it. At the end of the day, you don't eat at a Pizza Hut. You got so many gourmet pizzas available. I think those people have lost the plot in India at this point of time. Number one. Number two is the overestimation of market. In a country where almost 60-70% of people need to be fed food grains free of cost to survive, how big is your market for the QSR? And look at the pricing of those products. When they were cheap, they were good. When you price them the way they're priced today, you're taking it out of budget for a whole amount of the community of India and the consumers of India. So I think they were a darling at one time because one, they promised that we'll access a large market. The pricing base of the products was much more cheaper than what it is today. With today's prices, they have narrowed down their customer bucket, and that is showing up. Cloud Kitchen on top, home delivery on top, their goose has been cooked. So I don't think there's a great future there for a long time to come, given the fact they compete for retail space in malls, which is expensive. At the end of the day, the retail expensive, the maintenance cost expensive, people cost expensive. So they have a troubled life, I think, in the next couple of years because the cost is working against them. The consumer dynamics is working against them. They're fighting a consumer trend on a higher cost base. And that's why I think they will continue to underperform.
Has been cooked. Wow, what a lovely way of putting it, I would say. Ajay, tell us about, you repeatedly mentioned transmission business and transmission towers and some PSU companies in the power space. PFC, RFC variety, even after run-up, has, under one-time book. Have you looked at this recent IPO offering which is out there, IRIDA, the renewables, NBFC, or even Tata Technologies for that matter? Would it interest you?
Well, of course, see, PFC, etc. I can tell you one thing. This is what Nikunj was saying when you want to wait to buy. Not many may realize that PFC was less than 100 rupees with a dividend yield of 14% less than a few months back. I think that's an honest fact. All right. So, and we hold the stocks for that disclosure purpose at the end of the day. And we held it for dividend limitedly, not for capital increase. Again, back to the point. These are monopoly stocks of power finance. No bank can afford to fund it. Nobody. If you want to set up a power plant in this country, you go to these two companies, REC and PFC. There is nowhere else to go. IRIDA falls in the same bucket, absolutely. Monopoly status, government guaranteed, ability to access funds, ability to access global funds, green funds, is perfectly positioned for the right amount market where the green is truly green for even investors. So I think you are perfectly positioned to go for the IPOs should you be lucky to get it. The problem has been few IPOs like Tata Technologies, maybe one out of a family member may get it. So we don't even make an effort to put our family money in these IPOs because if you don't have institutional allotment, we don't do it. Because how do you get these shares? Now, when it lists at what price, we will see. But answer is yes. You got to be really lucky. Look at the lucky stars and apply for the right time on the Muhurtam. Don't apply in any other wrong time, and you might get it. So if you get it, you're lucky. If you not get it, wait for a time to get in. But both are good stocks.
All right, Ajay, always wonderful having you on the show. You just light up the conversation over here. Thanks very much
Thank you
for
very
your
much.
time today.
You're kind. You're kind. Thank you. Have a good day.